Welcome back. The markets today, October 22nd, 2025, they're a whirlwind. We've got chip giants like TSMC absolutely smashing records. You've got EV titans like Tesla on the edge of a make-or-break earnings call. And then you have software behemoths like Oracle just rocketing towards historic valuations. It is a lot. So today, we're going to cut through all that chaos and explore one of the most common methods for trying to find a clear signal in all this noise.
First off, let's just appreciate the sheer volume of information that investors are trying to sort through right now. I mean, it is a perfect storm of conflicting data points, and it's all happening at the exact same time. On one hand, the AI sector is just absolutely on fire. TSMC, the massive Taiwanese chip manufacturer, just posted record-breaking quarterly profits. Why? Well, it's driven by this insane demand for AI chips from companies like Nvidia and Apple. I mean, this is pure rocket fuel for the entire semiconductor industry. But then you look at another corner of the market, and the picture couldn't be more different. All eyes are on Tesla's earnings tonight. The stock is clearly nervous, and analysts are predicting what could be a fourth straight quarterly profit decline, mostly because of margin pressures. Honestly, nobody is quite sure what to expect.
And just to add another wild card into the mix, you have a legacy tech giant like Oracle staging this incredible comeback. It's surging towards a $1 trillion valuation, and not on its old, boring database business, but on massive, explosive growth in its AI cloud segment. It's a completely different story all over again.
So, this brings us to the core question, right? With all these competing narratives flying around, how does an investor decide what actually matters? When do you buy? When do you sell? And when do you just sit on your hands and wait for the dust to settle?
Okay, so let's dive into this. We're going to explore one of the most popular and, also one of the most controversial tools in any investor's toolkit, technical analysis. And believe me, it is a completely different way of looking at the market. So what is it exactly? Well, to put it simply, technical analysis isn't really concerned with why a stock price is moving. It doesn't care about profit margins. It doesn't care about what the CEO said in an interview. Nope. It is laser-focused on the charts, studying the patterns of how the price has moved in the past to try and predict where it might go next.
Now, this whole philosophy is really built on three core ideas. First is the belief that all the news, the good, the bad, the ugly, is already baked into the stock's price. Second is the idea that prices don't just move randomly, they actually move in trends. And third, and this is a big one, is the conviction that human behavior is predictable. So the patterns created by that behavior, well, they tend to repeat themselves. Okay, so theory is one thing, but the crucial point is to see how these principles actually apply in the real world. Let's break down what technical analysts are really looking for when they stare at a chart, focusing on these big ideas of trends and human psychology. The very first thing a technical analyst looks for is a trend. They believe that markets are driven by a kind of herd mentality. So an uptrend is just a series of higher peaks and higher valleys. And a downtrend is just the opposite. To them, this isn't random noise at all. It's the actual footprint of collective investor behavior. And this table from today's market illustrates the concept brilliantly. A technical analyst would glance at this and immediately see patterns. They'd spot the clear upward trend in the Shanghai Composite, they'd see the downward trend in the German DAX, and that sideways, uncertain movement in the S&P 500. Each one tells a different story based purely on the direction of the price. This brings us to that third, and maybe the most important principle. The belief that history repeats itself, well, it's really a belief about human nature. The same emotions of fear and greed that drove markets 100 years ago are still driving them today. And because those emotions are constant, the chart patterns they create should be recognizable and, more importantly, repetitive. Let's take Bitcoin, for example. Today's reports show it retesting a support level around $107,000. Now, to a technical analyst, this is not a random number. It's a psychologically significant price point where, in the past, buying pressure has been strong enough to stop the price from falling any further. They're basically betting that this collective behavior is going to happen again. Now, as you might have guessed, this method is far from universally accepted. In fact, it's at the very heart of one of the biggest debates in finance. It stands in direct opposition to other major theories about how markets actually work. What's so interesting about this slide is how perfectly it frames the debate. You have technical analysis, focusing on the how, and it's the polar opposite of fundamental analysis, which focuses on the why. A fundamental analyst is digging through Tesla's financial statements right now, worrying about those declining profit margins. The technical analyst, they're ignoring all of that,
focusing only on the chart pattern, that visible anxiety in the stock price that they might label pre-earnings jitters.
And then you have the academic view, the efficient market hypothesis. And it basically argues that both sides are just wasting their time. This theory says that all known information, from earnings to news, is factored into the price instantly. And that makes the market's next move essentially a random walk, as unpredictable as the next flip of a coin.
Princeton economist Burton Malkiel is famous for championing this view. He argued that if a chart pattern actually worked, so many people would use it that it would immediately stop working. The very act of observing the pattern would destroy it. He famously, and pretty colorfully, compared technical analysis to astrology. So you've got the chart readers, you've got the number crunchers, and you've got the academics who say it's all just random. With these completely different ways of looking at the market, what's the practical takeaway for an investor? Where do we go from here? The entire debate really boils down to this one question. Is there a science to reading charts, or is it more of a subjective art, or is it something else entirely? The fascinating thing is you can find really compelling arguments for all three sides. And here it is. This is the crucial point that might just resolve the whole paradox. Whether the patterns are scientifically valid or not is almost irrelevant. The fact is, millions of traders around the world believe in them. They watch the same support levels, the same trend lines, and they all place their bets accordingly. Their collective action can be powerful enough to actually make the prediction come true.
So let's just recap what we've covered. Technical analysis is a lens that uses past price and volume data to find trends, and it's all based on the idea that market psychology is repetitive. It stands in stark contrast to fundamental analysis and is dismissed by a lot of academics. But its real power? It may not come from its predictive accuracy, but simply from its popularity. And that leaves us with one final, kind of provocative thought. In a market driven so much by human belief and emotion, if millions of people are watching and acting on the exact same signal, does it even matter if that signal is real, or does their belief itself make it real? That's definitely something to think about.